The Moving Iron Podcast is brought to you by these great sponsors. Are you looking to value your equipment more accurately, target the right buyers and close more deals, reach your ideal customer? Then look no further. Fusable isn't just about ag data, it's about action. Our best-in-class solution empowers you to value your equipment accurately, make informed decisions, and find the perfect prospects. Ignite your dealership's growth at fusable.com/movingiron-podcast. Out in the field, every decision counts. You wouldn't plant without testing your soil, so why would you prospect blind? Introducing EDA, your one-stop shop for ag equipment intel. EDA goes beyond specs and prices. You get deep dive data on every piece of equipment like UCC filings that help track ownership changes and uncover potential sales leads. D&B firmographics, which help you understand the financial health and buying power of potential customers. Market trends that help you stay ahead of the curve, and insights on equipment demands and pricings. With EDA, you're not just looking at data, you're seeing opportunity. Find the right buyer, sell smarter, and build lasting relationships. Visit edadata.com for your free demo and unlock the power of knowledge. For over 80 years, Iron Solutions has been your go-to data source for ag dealers, lenders, and manufacturers. Get powerful appraisal and value forecasting tools that fuel profitable decisions anytime, anywhere. Get your free demo at ironsolutions.com. Iron Solutions, confidence in every click. Today, there are many ways to finance ag equipment, but nobody delivers simple, fast, or flexible financing like AgDirect. Learn more about your options to buy, lease, and refinance equipment at agdirect.com. Valley Transportation has been hauling ag and construction equipment across the country for the past 33 years. Call Parker at 800-657-4910 for all your trucking needs. At Valley Transportation, our goal is to help you reach yours.
When you partner with Axon, you immediately gain access to a full range of products and solutions designed to meet the complex needs of today's grower. We carry all major brands and sizes of tires and wheels. We specialize in large diameter wheels for large equipment. We have one of the largest OEM replacement wheel inventories in North America. Known for extreme flotation setups, duals, and triples, we have wheels for all makes and models of tractors, sprayers, combines, and grain carts. If we don't have the wheel in stock, we'll custom build, sandblast, and paint in-house. There isn't a more vast inventory in North America dedicated to helping dealers move more iron. With facilities on the West Coast and in the heart of the Midwest, leverage our 230,000 square feet of indoor inventory to solve any problem a grower may have. Move more iron with Axon.
Moving iron in the 21st century. Hard-working people working hard for you and me. Moving iron time and time again. Through the years you'll find us here. Moving iron.
Hello and welcome to Moving Iron Podcast. Marks with Sean Hackett. Sean Hackett is with Hackett Financial out of Boca Raton, Florida. He's nice enough to come on and talk about what's happening in the world of commodities. Sean, how you doing this morning?
Never been better. I'm excited to get on the road again after a little bit of a brief pause here over the summer to get back on the road. I got a new presentation. Going to talk about all kinds of new things, and so I'm excited to get out there. It's obviously with where grain prices are. I think this is an important time to make correct decisions. It's always important, but I mean, I think we're at a pretty critical time that if you do the wrong thing right now or the right thing right now can mean a huge world of difference in terms of how much money you're going to bring home on the farm. And so I'm excited to get out there and hopefully convey the correct message to those at the meetings that I'll be at. So
right on. Okay. We're looking forward to that. Where are you going to be at?
Savannah on Sunday. Then I'll be in Indianapolis on Wednesday, market to market on Friday, and then I'll be up in Kentucky on August 22nd speaking. So I got a nice flurry of conferences here, different places here. So
right on. Okay, man. Everybody pay attention where Sean's going to be at. Maybe you guys can go and see him talk live in person. So, Sean, let's talk a little bit about this first. Let's hit the Fed report. Nothing big came out of the Fed other than possible rate cuts seeing in September. You've been talking about that a little bit, that you say, hey, time's there. You saw the Bank of England cut rates here this past week, or no, this week actually, and you saw that there. So you're starting to see the world's kind of thinking that inflation is under control and starting to making some moves. So any remarks or any reactions to what you saw come out of the Fed this week?
This was one of the biggest bonehead meetings, a classic bonehead meeting. I hate this. I don't tend to like to make disparaging remarks, but the Fed there was no reason why they shouldn't have lowered rates a quarter point on this meeting. Why wait till September? Why? The economic numbers are accelerating to the downside. It's clear. And so they came out and they did they did the Federal Reserve two-step, and the stock market is crashing. And the stock market is going to call their bluff. I believe we will not have to wait until September for the Fed to cut rates. The market has spoken. It heard what they said, and they are living in this world of fantasy of their models, and they needed to get on with business and lower rates in this meeting, and they balked. And the typical Fed, they lose every single time. They wait too long. They're hesitant to take swift, strong action, and then the stock market crashes. The economy then accelerates to the downside, and then they have to come in realizing that they made a mistake, and then they have to then get more aggressive with rate cuts later. That's where we're at. And so it's a good thing and a bad thing. It's a bad thing because it means more downside potential in markets in general, in aggregate, short run. But it's going to bring them to the table even faster, maybe even more aggressively. Instead of doing a quarter point, maybe they're going to do a half a point instead, because they're going to need to calm the fears of what appears to be an escalating stock market crisis, AI stocks crashing. I mean, we're really seeing some very challenging consumer-oriented numbers. Hershey comes out and says the worst sales I've seen in a long, long time. They can't sell any chocolate to anybody. I mean, bottom line is, they just totally fumbled the ball on this one. Completely fumbled the ball. Anyway, so I'm not surprised because they always do this, but the immediate market reaction is calling their bluff, and they're saying, and they're going to remember, there's an election coming up. And it's just unbelievable to me that with an election coming up, they're going to wait till September. And now the economy, I mean, the last thing that those that are currently trying to run for re-election, whether it's the senators, the congressmen, or the current administration, last thing you want is a crashing economy,
right?
Going into the elections. It's just, they're going to move, Casey. I'd be willing to bet they'll have an emergency meeting sometime later on in August. I don't know when, but in my opinion, this is not going to stop until they act. The stock market is not going to stop putting pressure on the Fed until they act. And so I believe they'll call an emergency meeting sometime, I don't know, mid-late August, and they're going to probably they might even do a half a point, depending how bad things get, at least because the stock market runs the whole deal, runs the whole thing. Everyone's 401ks in stocks. All spending, discretionary spending, is based upon how your 401k is feeling. Of course, housing prices, we're starting to see pockets of crashes in regions. Well, if your 401k is looking bad, all of a sudden you lose your job. I think jobless claims were the highest reading in a very, very long time yesterday. Well, all of a sudden the housing market starts to go down, and your two biggest points of equity for most people, which is stocks and your home equity, start to go down. You have a problem. And of course, we already know the regional banks are still bleeding from the higher interest rates, and they still are not healthy and are still not extending credit. Just a complete bonehead move on the Fed, as they typically do. So we are in a rapid, dynamic time for wild volatility down, and then a significant shift back up when they start acting more aggressively. And that's really, really going to be positive for commodities. And the reason I'm saying that is when the stock market is rocketing higher week after week, month after month, the capital gets sucked out of commodities. We've seen this over and over and over. when the stock market has difficulty, when it's struggling, the capital looks elsewhere and the capital starts flowing back into commodities. So for the period from 1998 to 2012, the stock market was flat during that entire period of time, and commodities went through the roof because money was not being treated well in stocks. So it's almost like we're starting to break apart the capital flows from what they were or what they've been to something completely different. So even though stocks declining short term hurts commodities a little bit, always does for a little bit, it's actually what's needed to shift the trend where commodities start outperforming stocks. So I'm very optimistic that we're going to start to see this shift between cheap commodities, expensive stocks, and the U.S. dollar, which has been obviously a difficult headwind that we've been dealing with. We've talked about on the show quite a few times. That's been hurting our U.S. translatable dollars from foreign dollars in terms of foreign prices and our exports. That's also going to come on our side, and we're going to start to get that tailwind, something we really haven't had in quite some time. So very, very exciting times for big shifts in markets, and I'm very optimistic that there's going to be some very, and of course with the elections coming up, that's going to supply its own set of volatility parameters depending on who gets in and what kind of policies we're going to have. So this is not a time to be this is not a time to be offline. I mean, this is time to be very engaged and active because you're going to get a lot of volatility, and there could be some good opportunities to buy, physical buyers to buy and physical sellers to sell, depending on exactly how these levers are pulled and how they go. So I think this is time to be very engaged and active in the cash side of agriculture right now. Definitely not a time to be asleep at the wheel.
For sure, man. All right, let's jump over and talk about what's going on the corn crops. So we've got pretty much all of this week, starting next week, end of last week, pretty much. You saw a 3 in front of December corn. This morning it is at $4 right now, maybe just a tick higher. Haven't seen what the ticker looks like at this particular moment in time, but right before we started, it hit $4, and you're seeing a lot of conversations about a big crop coming, and I think you're in agreement with that Shawn, that there is going to be a big crop coming. But
there is? Really?
No one said that yet, right? They had
nobody told me there's a big corn crop. You got to be kidding me.
You brought the point up that the crop is going to be big, but the number of acres planted is going to have a big effect on carryouts. So I guess talk a little bit about that.
I always try to remind people there's the balance sheet, there's the spreadsheet numbers, and then there's what actually happens. The futures market trades what they think the future is going to be today. Right. And so what they're trading right now are spreadsheet ending stocks, not actual ending stocks, spreadsheet ending stocks, which never materialized. In my 30-year career, I've never seen the spreadsheet numbers that you come out a year ahead turn out to be the correct numbers. Either they're too low or too high. So the way I see it, we're likely going to see the corn yield of probably between the next two WASDE reports get to something around 185, give or take. We can slice it and dice it in 1,000 different ways, but everything says that is probably where we're going to go. And I think that's the right number based upon what has taken place, give or take. What I do believe is that we've already seen them lower in old crop stocks in the last report because they overestimated last year's crop. I think there's more of that to come. I don't think they're done correcting their error of overestimating the corn yields, and even to some extent the soybean yields from last year. There's more to that to come. So that's going to lower those starting old crop stocks a little further. There's no question in my mind that the harvested acres are going to have to come down somewhere between 500,000 to potentially 1 million acres on corn, maybe 500,000 acres on soybeans, because I do think some of the wet weather did shift some acres to soybeans. But those planted acres, those harvested acres, are going to come down some, which lowers the bar some. It's pretty clear demand is stronger today than it was a year ago. We're seeing that with bigger export numbers. We're seeing that with stronger domestic demand, which means they're going to bump up the demand here. So even getting to 185, which would be 4 bushel to the acre, right? More than they've said in the last report. So if you view what they claim to be 81 million acres, Casey, right? 81 million acres times 4, that means 324 million bushels, all things being equal, would have to be increased to ending stocks, which they said at the last report was 2.1. That would mean getting to 2.4, all things being equal, okay? But if what I just said, which is lowering old crop stocks a little, lowering those harvested acres a little, increasing demand a little, I don't think we're going to get much higher than 2.2, maybe 2.3, maybe. That's the high side. But when you look at the U.S. stocks, the corn stocks, for example, to usage, because at the end of the day, the supply in and of itself means nothing. It only means something relative to what the demand is for the product. In 0405, when we had over 2 billion bushel carryout, our stocks to usage were 18 to 20%. Well, if we use the 2.3 number, let's say that's the number we ultimately come to, based upon the current demand, we're going to be at a stocks to usage of around 15%. So which means our stocks to usage, even though it's similar to what it was in 0405, is still much lower. And I think people always look at the nominal supply and they don't factor in the fact that demand has grown and that the share of demand relative to supply is not the same. And so the overhang is not the same. So we're just not in the same overburdensome level that everyone is suggesting. And the other factor, Casey, and it's something that's very, very important. I see so many current estimates or current analysts making this estimate that, well, the market clearing price between 2014 and 2020 was 3.25 December futures, because when we had over 2 billion bushel carryouts, that's what it was. And so that's where we're going to go, because our carryouts over 2 billion. So because of that, that's where we're going to go. But that's assuming you're comparing apples to apples. Are we? Is it apples to apples, Casey? Did the world not change post-COVID when we printed the largest amount of money in the history of the world, that we borrow the largest amount of money in the history of the world, and we fiscally spent the greatest amount ever? And inflation went up with some of the greatest rate of inflation rates on a 3-year basis we've seen since the 1970s. You really mean to tell me that you're saying that the rule sets today are the same as they were pre-COVID? Really? Why would the market clearing price today be the same as it was pre-COVID? It makes absolutely no sense whatsoever to me. I'm not saying that that's impossible for something to happen. Markets can do crazy things. What I'm saying is it makes no sense. The chances that that is going to be the market clearing price again, in my opinion, is a very, very, very outlier. And that the market clearing price, remember the market clearing price in 0405 was 175 corn. How come we don't go back to 175 corn? Because the economy has fundamentally changed post the financial crisis of 0809 and post-COVID. It doesn't seem to me, seems to me that we're going to develop once again a higher clearing price where whoever needs to do whatever they need to do, a market clearing price. I think corn and soybeans are going to make a higher market clearing price today than they did between 2014 and 2020, just like 2014, 2020 made a higher clearing price than we had in the 2000s. That to me seems to be the much more probable, correct forecast going forward than what is being pontificated by many who I don't think are just looking at things in the way that I think historically you should.
Yep. So I'll just read an article here as kind of through some little notes that I get every morning. And to your point on inflation, you're starting to see, it says here that you're starting to see big food manufacturers slowly are slowing price hikes and offering discounts to win back customers frustrated by inflation. So
McDonald's, the $5 meal now, it's permanently on the, because I mean, when chocolate, when Hershey says chocolate sales are getting creamed, I mean that's
no pun intended.
No pun intended.
That's a good one.
Wow, Casey, you're in the wrong line of business, man. Take it on the road. But I mean, chocolate demand is usually fairly impervious to things, and even I'm not saying one particular company. I mean, but there's a problem there, Casey.
Right.
And the Fed goes, well, we're going to wait till September to maybe lower rates 0.25%. Oh, come! What a joke! Complete joke.
Yep. So a lot of moving parts here, man. You look at what's going on with inflation, what's going on with the crop comparatively to what, stuff out there, a lot of stuff headed to watch.
And getting back to this WASDE report, who is not expecting the most unbelievably bearish report ever recorded in the history of WASDE?
Right.
Everybody, oh my gosh, yeah, that's good. I mean, it just reeks of sell the rumor, buy the news. I mean, it just reeks of it, Casey.
Right.
Just reeks of it. I mean, who hasn't sold corn because we're going to have this infinitely large crop and it's never going to ever go away again. I mean, that's where I think we are psychologically. Anything can happen. I don't know what they're going to say. I don't know how markets are going to react. Markets do what they do. But my 30 years of experience tells me that you're playing a dangerous game right now with sentiment as negative as it is. And if you're a physical buyer, this is really the case for the physical buyers. If you're a livestock producer, if you're an ethanol producer, if you're a renewable diesel producer, if you're a bean crusher, I think you're playing a dangerous game if you're not extending cash coverage here and or doing something to protect your upside price risks. Because what tends to happen when the more you pressure and you tighten the spring and you increase that modulus of elasticity to the downside from normalcy, when it does at some point spring back the other way, it happens so unexpectedly. And it does so oftentimes so violently that you're left at the altar trying to chase the market now when you had ample opportunity to lock in long-term economic advantage. To me, trying to wait out for another 10 or 20 cents down in corn is not worth it versus what I think the next 6 months, 12 months, 24 months might look like for what prices could do if some of these factors that we've been talking about come to fruition here.
Right on. Okay. Sean, let's talk a little bit about what's going on over in the proteins. As you look at what's going on with the cattle market, you're seeing some movement there. You're seeing some prices start to move lower, and you're seeing some movement there based around what you're seeing with current commodities and those kind of things, or current market situation. My bad. Sean, as you take a look at the cattle market, what are your thoughts there?
I just think that we're seeing some speculative liquidation in cattle last few days because of the stock market. There's a high correlation between stocks and cattle prices on a short-term basis because, look, let's face it, people that are putting out spending $60 on a steak dinner, at a high-end steak restaurant, I mean, that that's something that can be impacted if the economy starts to really head south, if the stock market gets hit, because all those people have most of their money in stocks anyway. And so people worry, correctly so, by the way, that there could be a pullback on beef demand, at least the worry about it. Now, obviously, we have very tight supplies, but in the short run, this kind of scenario, Casey, just brings worry into the livestock sector, especially beef, which is so high priced relative to what it historically has been. And so I just think that's what you're seeing there a little bit. Look, in my view of pork prices are already pretty undervalued, pretty cheap. I think the biggest issue with pork is I talk to a lot of people in the pork industry and in the hog industry, and I think the takeaway I get is one of the biggest reasons that there's such a disparity between the pork cutout price and the beef cutout price is because we've decided to go for efficiency in the hog industry versus flavor. This is not me talking. I don't understand the hog industry like people who are in it. I'm telling you what they're conveying to me, that when you used to eat pork, you used to have more fat, you used to have more flavor. And now it's just so efficient and so lean that there's no flavor. People just don't want to eat it. They don't want to eat it. And I think we need to get back to flavor than necessarily efficiency at the expense of flavor. If you give them flavorful pork, I believe people will pay up for it. It can be done. It's not like this is an impossible task to rehabilitate. The beef industry certainly has created a lot of flavor, and that's one of the reasons why beef demand has been surprisingly resilient. But I think we got to get back to basics. People will pay up for what tastes good. We're already learned from the Beyond Burger and the Impossible Burger that you create this fake burger from pea protein and such, and it doesn't taste good. And they're all going bankrupt because people aren't going to pay up for something that doesn't taste good. Even if it's healthy for you, they're not going to do it. 7% of the world, 7% of the U.S. population are going to eat veggie burgers because they want to do that, because for their health. The rest of the country will do it only if it tastes good. And the great test example of what happened with Beyond Burger and Impossible Burger and how they went through this meteoric rise and crash to bankruptcy is a classic example of flavor wins over not. And
Yep.
and that's, to me, you want to get that pork cutout price up, you increase the flavor, it'll take itself. But pork prices are cheap enough. I don't think that's the factor there as much as what I just mentioned.
Right on, man. Okay. Sean, good place to stop there. Folks want to reach out to you, get more information about where you're going to be speaking and what you got going on over at Hackett Financial. What's the best way to do that?
Our Twitter page at Faradex11. We have a LinkedIn page as well. Website Hackett, HACKETT advisors.com. I want to remind everyone, we don't sit at our computer all day posting on social media. We have far better things to do with our lives and analyzing markets and helping our customers. But from time to time, we will post some things on there that might be of value to those watching your show about the way we look at things with our correlations, our cycles, and our statistics.
Right on, man. Sean, appreciate you being the podcast, man. Safe travels the next couple of weeks here.
Sounds good, Casey. Thanks so much.
Right on. I'm Casey Seymour with Moving Iron Podcast. Check me out on Facebook, Twitter, and Instagram at Moving Iron LLC. Go to LinkedIn at Moving Iron Podcast. You can check out the video version of this over at the YouTube channel, which is the Moving Iron Podcast YouTube channel. And something special here we're going to do with Sean and his listeners. We're going to start doing these live, and we'll put these out so you can see them. If you're one of Sean's subscribers, you can check this out live, and then we'll post this out on the recording at a later date behind that. So if you're interested in Sean's research and what he's doing, there's another added benefit for you. You get to see some commentation about what's going on out there live as it goes through that. So check that out. Go to Moving Iron LLC for everything Moving Iron related. And while you still can, go to TikTok, and you can see us over there as well. So with that, I'm Casey Seymour with Sean Hackett. It's going to move some iron, folks. Out. Iron Podcast is brought to you by these great sponsors. Are you looking to value your equipment more accurately, target the right buyers and close more deals, reach your ideal customer? Then look no further. Fusable isn't just about ag data, it's about action. Our best-in-class solution empowers you to value your equipment accurately, make informed decisions, and find the perfect prospects. Ignite your dealership's growth at fusable.com/movingiron-podcast. Out in the field, every decision counts. You wouldn't plant without testing your soil, so why would you prospect blind? Introducing EDA, your one-stop shop for ag equipment intel. EDA goes beyond specs and prices. You get deep dive data on every piece of equipment like UCC filings that help track ownership changes and uncover potential sales leads. D&B firmographics, which help you understand the financial health and buying power of potential customers. Market trends that help you stay ahead of the curve, and insights on equipment demands and pricings. With EDA, you're not just looking at data, you're seeing opportunity. Find the right buyer, sell smarter, and build lasting relationships. Visit edadata.com for your free demo and unlock the power of knowledge. For over 80 years, Iron Solutions has been your go-to data source for ag dealers, lenders, and manufacturers. Get powerful appraisal and value forecasting tools that fuel profitable decisions anytime, anywhere. Get your free demo at ironsolutions.com. Iron Solutions, confidence in every click. Today, there are many ways to finance ag equipment, but nobody delivers simple, fast, or flexible financing like AgDirect. Learn more about your options to buy, lease, and refinance equipment at agdirect.com. Valley Transportation has been hauling ag and construction equipment across the country for the past 33 years. Call Parker at 800-657-4910 for all your trucking needs. At Valley Transportation, our goal is to help you reach yours. This podcast is proudly provided by Axon, helping dealers move more iron for the past 100 years. Find out more at axontire.com. Move more iron with Axon.
Moving iron in the 21st century. Hard-working people working hard for you and me. Moving iron time and time again. Through the years you'll find us here.